Hi, it's Michael Farr from Farr, Miller and Washington. In the news this week, Cyprus. Not exactly Greece, not exactly Spain or Italy or any of the other southern European countries that have been getting into trouble. Cyprus, kind of overlooked for a long time. But it too, of course, needs a bailout. Not a particularly big one, but a bailout well into the double digits of billions. So that's not insignificant. They're going back to the European Central Bank and to the strongest nations in Europe financially, and really all eyes go back again to Germany. We're reminded of a couple of things, and we've been confronted with a new and really stupid problem. So we're returning again to the notion that there is still a significant problem in Europe. A lot of the southern European countries don't have tax revenues sufficient to meet their spending. They've created huge deficits, they continue to increase their debt, and they're reaching these moments where they're no longer solvent. Now, if that doesn't ring somewhat familiar, you're not listening to what's going on in the United States. We're beginning to address our problems, and most of the arguments in government right now are whether we can really find a way to slow deficit spending. Not stop deficit spending, we're just trying to dig the hole a little less quickly. We're still digging the hole, make no mistake. The solution proffered by the central bank in Europe for Cyprus was to tax all bank deposits at 10% across the board. You had, $1 million deposited or being held in banks in Cyprus. You woke up the next morning and $100,000 was going to be gone. You were going to have a $900,000 account instead of a $1 million account. And that was just the tax that was going to be levied so that they could help return to solvency. This was a really bad idea. It wasn't those depositors necessarily and universally who caused Cyprus's financial troubles, economic troubles, and yet they were the ones who were going to bear the penalty. Just so what we saw when that happened was we saw world markets, European markets, and markets in the U.S. go lower. The euro fell. The dollar rose. Bonds went up, and yields on U.S. Treasury bonds fell precipitously. Why? Because as people got nervous in Europe, they began to buy U.S. Treasuries in the United States, driving the prices higher and therefore the yields lower, number one. Number two, they didn't like the euro because clearly somewhere in here it looked like we're probably printing more of them, and we didn't like this confiscatory action could weaken all the banks in Europe. So the euro fell and the dollar strengthened. Overnight, we've seen the Cypriot government reject the plan to confiscate 10% of those bank assets. Banks have not opened in Cyprus at all this week. Today's Wednesday. So they announced this over the weekend. Banks couldn't open. They were fearing a huge run on the banks, similar to the Depression era in this country where we saw runs on banks. So they're not going to confiscate bank assets and depositors' assets, which we think is a very good thing for the maintaining trust in the banking system worldwide. But we're still left with this thorny problem of this little island country that needs a bailout still, and still has to look to the IMF or the World Bank or the Russia. They're looking all over, but they need a bailout. Somebody else needs a bailout. And they're in the deep and very tall boggy reeds if they don't get it. Since we saw the Cypriot government say that they're not going to go ahead and they're not going to go forward with this plan to confiscate assets, U.S. bonds have fallen, yields are increasing, the euro is strengthening, and the dollar is falling again. So we're seeing that reverse again in the markets. How long is it going to last? U.S. stocks fell Monday and Tuesday of this week. They fell Friday, Monday, and Tuesday. So we saw a 3-day lull in stocks and a pause in what's been a very powerful rally. Before the open this morning, stock futures are now markedly higher. So it looks like our stocks are going to also rally back as maybe faith and trust in the banking system could be maintained. We've said for a long time that this European problem's not going away. We don't think it's going away anytime soon. We think that it's going to continue to cause problems, and it's far from being solved. I'm most encouraged to watch what's going on in the United Kingdom as they are more aggressive in facing their fiscal deficits and overspending and imbalances. It's been painful, but they really have pursued austerity, and I think they're going to make greater progress, certainly than the rest of Europe and perhaps than the United States. We seem to continue to benefit from being the world's currency and the largest economy in the world, and that can last, and maybe last and last. Point is, we don't know. So, stock valuations are full, but not unreasonable. Interest rates continue to be low and show no signs of going any higher. The Federal Reserve is going to come out, the Open Market Committee is going to come out with its position on interest rates later this afternoon, and we expect their quantitative easing to infinity, these $85 billion monthly purchases they're making, to continue unabated with no plans in sight to raise rates given this news of ongoing threats to the European economy and still what seems to be a slow recovery here. More of the same, so we expect this rally today, I guess, will continue. As long as the Fed keeps spending, it seems reasonable that stock prices may go higher, even though they're not being driven by fundamental demand and fundamentally organically growing S&P 500 companies with growing, expanding businesses. Earnings have improved because of productivity and cost cutting, and there haven't been any wage increases. As the economy improves, those companies that have large labor forces will be most vulnerable to their profit margin contraction because they'll begin to see their labor costs go up and their margins are going to come down. They've lived in a very nice artificial world and operated for quite a while. So profit margins are at all-time highs. We expect them to come down a little. I don't think we have a runaway market, is my point. So we continue to be cautious. We are enjoying, I mean to tell you, we're enjoying these new market highs, and asset growth that we're having at Farr, Miller in Washington is terrific. This is not a time to swing for the fences. It is not a time to take your eye off the ball. It is a time to double down, work harder than perhaps we have in the past, if we can do that, to really uncover and go through balance sheets and make sure that when we find numbers and assets that they are absolutely there and verifiable, and that the earnings growth that we see is understandable, is logical, is rational, and that we think it continues to have a future, that earnings growth. We find those things, we hold those companies, we hope that more of our decisions are right than wrong, and that we continue to pursue and protect and defend our clients' interest to the best of our capacity. So, hang in there, be careful. It's not all bad today, but not a lot's changed. For Farr, Miller in Washington, I'm Michael Farr.